I'm Andrew Bell, this is Cote, and I'm going to introduce the company for a second. He's going to do the first part of the presentation, which takes you right up to the center fold here. So mainly dealing with Shoats Creek in Louisiana, and I'm going to wind up at the end with the remainder of the presentation. So natural resource developer, we describe this as, and recovery play is the key words here on the third page, which picks up what Paul was saying earlier. I'll hand over to Scott.
Hi, thanks for everybody coming tonight. We appreciate the turnout. It's good to see everybody here excited about where we are in the market and where we're planning on taking these two companies over the next years and months. So we'll skip to the disclaimer. As Andrew said, I mean, we're trying to make a very simple message here. The reason you're going to invest, either already invest or going to invest in Red Rock, is for this reason. It's because you, like us, believe that this market is turning around, that you want to be part of that story and that upside over the next month. So it's very simple. We're just laying it here. We feel that we're a great recovery play, and we're trying to position ourselves to be the premier recovery play on AIM. And we think we have a portfolio that offers that upside, and we're going to run through that here over the next few minutes. So who we are today, I mean, what do we give you when you buy a share of Red Rock? What exposure do you get? You get exposure to petroleum assets and to mineral assets. And the focus for us over the last 6 to 12 months has been near-term cash generation. And that's very different from where we came from. We were originally taking very big bets, very risky bets on assets that could go through the roof. But if they didn't, they cost a lot of money. And what we're doing right now is we're taking smaller bets on cash generative assets where you drill a small oil well in Louisiana and you're making money 4 to 6 weeks later, and that's very different. And we feel this fits beautifully in the portfolio of existing assets that we already have that we're going to run through over the next few minutes here. So what do we offer? We offer diverse commodity exposure. I mean, there's few AIM companies of our size that can get you exposure to gold, to oil, to manganese, a variety of different assets here. And we think you'll be hard-pressed to find an AIM share that offers this much in a package of the size that we're at the moment. Cost structure, a year and a half ago, we probably had 18 to 20 people in the business. As of today, we're running this business with 3 people. And we say that in the upside. I mean, we can certainly rely on technical consultants and outside help when we need to. But this business is as lean as it's going to be, as lean as you can possibly run an AIM company. And we feel that's the right place for this stage of the market right now. As far as the opportunities, the reality is we're seeing stuff come across now that you couldn't have gotten into 6 to 12 months ago. Frankly, it didn't exist. Or it existed, or you couldn't afford it. We couldn't afford it. Those are the kind of things that are coming into the business right now, and we're going to talk a little bit about that over the next few minutes. But the reality is, much like you as investors investing at this stage, we as the entity investing at this stage also can get access to stuff that, frankly, wasn't on the cards before this. And frankly, we're positioned for outperformance. And again, that really comes down to the assets, and we'll cover these in more detail. But we really feel there's tremendous upside here, and we'd like current shareholders to benefit from that and future shareholders to come participate in that upside. So the focus over the last 6 months, as I said, last 6 to 12 months really has been generating these different revenue streams and kind of lining up this graph that I put in front of you here right now. And we've tried to just make it very simple, where the money's coming from, how we're going to continue to grow it, and what you can reasonably expect from us. So earlier this year, we came on stream with our first oil well, that's the LM20. We got a major payment from a gold mine we sold in Colombia. And we've expanded some of, actually we're making real estate income because we've subletted our office. So at one point we had a fairly significant office space. We're actually making a bit of money now on subletting that to other partners. It's a small thing, but when you're a small, relatively low-cost structure AIM company, every bit matters, and it does matter for people coming in today knowing that they're not funding real estate or office costs or any overheads like that. In Q2, LM19 came on. We'll talk a little bit about that, or is in the process of coming on now. And our royalty stream in Colombia started to gather steam as the new owners of the mine produce gold. In Q3, we're looking at a couple oil wells spudding, the 21, the 22, and the 23. Sorry, and the LM9. We have another Colombia royalty payment coming in, Colombia royalty payment coming in over time. We have another Colombia cash payment coming in, just a $225K. And we're actually trying to accelerate a promissory note. We have a $1 million asset or pound note that we can try to move forward and convert into something more liquid than that, accelerate that timeline. So that's something we'll cover in more detail. And towards the end of the year and beyond, we have another oil well, the LM23, as well as the potential for one of our major investments to start throwing off dividends, and we think that could be a meaningful amount of money to the company as well. So hopefully this gives you the idea. I mean, this is the sort of graph that we literally couldn't have put up in front of you a year ago, and now it's here. Now at the least, we hope it's going to cover and make us a bit of money, cover our overheads and make us a bit of money, and potentially be a bit more than that. But you combine that with what Andrew and myself are going to cover, the existing portfolio, which actually has some real lottery ticket size upsides in there, and we think it's a compelling proposition and one that should attract investors. So I'll cover our first asset and then I'll hand it over to Andrew. This is where our money's been going lately. This is an onshore U.S. oil and gas play in Louisiana where we're partnering with another company. We, as you see here, have a 20% working interest, which means we pay 20% of the costs. And for that, we get 14.4% of the income in from the business. And that's a pretty normal setup. This is pretty reasonable. Shoats Creek itself, it's about 1,600 acres, decent-sized place, targeting the Frio Sands, and I'll show you a little bit more about that. But what is it basically? It's cheap onshore oil and gas. That's what it is, and we think it's appropriate for this point in the cycle. We're partnered with two companies. One is on AIM, they're called Cote, and the other one is actually a really big company called Gulf Western. These are the kind of people that sell investments to dentists and doctors and other people that need places to invest. They find assets, they then bring in people like that, and they invest in assets like we have here. So bringing them on is meaningful because it takes a lot of the costs off Red Rock and off North Cote and means that we can really accelerate the plans to develop this asset here. So we have, as I said, 20% working interest, and the work program for this year, I'll outline some of that in more details, a little bit over 2.2 million, of which we'd be spending 450,000 US, maybe a little bit more than that, depending on how it plays out. So what is Shoats Creek? Again, it's an existing field. It's not something new. People have been drilling here since the 50s and earlier than that. We're trying to go in and infill drill. So we're not doing pure exploration. It's nothing like the kind of mineral exploration we've done traditionally, where we go into a greenfield space, come up with a thesis, and hopefully find what you're looking for. We know there's oil there. It's just a matter of optimizing how to get it out. So it's low risk, I think, is the key takeaway here. And it has potential for growth. I'll show you here in our next slide how exactly it fits. But we're targeting the cheapest, shallowest part of it. There are some additional deeper targets that frankly are also very exciting and may be part of that story over the next couple of years. But with oil where it is today, we think we're doing the right thing for the right time. Again, it goes back, as it says, it goes back to the 1950s. There's 20 wells already in the field, some of which are on producing, most of which have been shut in. It's a sort of a mix. But the bottom line is, this is what we're targeting. We think it's the right time in the right place. This is Shoats Creek, and this shows you a little bit graphically of how the different levels work. At the top there in the blue, you can see is the Frio Sands, and that's what we're targeting right now. This is the cheapest accessible oil in this play. Beneath it, you have something called the Cockfield, which is a lower horizon, and below that, the Wilcox. And if you Google these things, you'll see that companies have been working in this area for years. As you go deeper, you spend more money, and potentially get more upside, but you take way more risk. Frankly, you can have certainly more problems that, drilling deeper and trying to complete wells in that area. And so we're taking what I would call the easier route out, but the route that's appropriate for $30 oil, for $50 oil, and probably a little bit above that. If things improve, if oil prices increase, you could definitely see yourself playing in these deeper spaces and taking a little bit more risk. And that's kind of why we like the project. It offers something for today and maybe something for tomorrow. And I've outlined the first couple wells here. You can see the LM20, the 19, the 21, and the 22. So the 20 is in production. This has been producing since February. It's targeting the Frio Sands. It costs, at this point, a little over $1 million to drill. We backed into it. It actually had been completed prior, but we ended up buying it a little bit after that. Interestingly, and I think another thing to show you kind of the upside in this project is the LM19. This is a well that's completed, and this is kind of how I demonstrated here, in the Cockfield. So if you see, it's actually been completed in the deeper horizon, but it's part of the package. What North Cote and the operators have done, I think we skipped here. Sorry. Okay. Oh, sorry. Andrew's playing with the thing there. What the North Cote and the operators have done is basically, what they do is, it's called a cement squeeze or a squeeze job. They've effectively taken that existing well already sitting there, and Andrew and I actually walked up to the well and got oil out of it while we were there. And they've cemented it in the upper horizon. So in the same horizon we're already in. And it costs $40,000. So for $40,000, of which we paid something like $8,000 or something like this, or actually will pay $8,000, you're going to get, well, they're targeting, say, 35 barrels of oil per day, but we're hoping it could be a multiple of that. I mean, we'll see. That's certainly not confirmed, and it remains to be seen where that plays. But for $40,000, you could get a fair amount of oil production. And that's why this is interesting. It's not pure greenfield. The 20 was a new well. They drilled it straight up. The 19 was an opportunity that came up, completed it for 40 grand, and it'll be producing here in the next week or so, or that's the current plan anyway. These two other wells, so the red wells are in production, the blue wells are not. The 21 and the 22 are the next two wells. We're going to be doing those with Gulf Coast, who I already told you about, this third partner. One is due to spud here in the next couple of weeks, and the other one realistically is going to spud towards the end of the year. But just to show you the opportunity, these wells cost $1.4 million a year and a half ago. Today, we think we can get it done for $750K, and that just shows you the opportunity. Drilling costs have come way, way, way down, frankly, and we think that's, if you think about the economics, we don't need $90 oil when the cost of drilling has gone down 50%, and the models show that, and that's what we're trying to show. So Bottom line is we think this is the right sort of play for today's environment, and we think it balances beautifully with the assets that Andrew's going to talk about, which are a lot of the residual assets of the company, the ones where we've had multi-million-pound spends over the last couple of years. You get all that for free. Anybody investing today, your new money's coming into this, cash generative, but you get all the old stuff for free, and we'll go through that in some detail here. So finally, economics, as I said, $750K. I run all the discount rates at 18%. I know the industry likes to use 10%, but I'm an MBA and I like to be more conservative than that. So I run them at 18%. If they don't work at 18%, we don't do it. It's that simple. So, you know, it needs to be aggressive on this. We always assume that whatever the operator projects on projections, we kind of cut it back 50%. I mean, we're not here to take huge risks in this part of the portfolio. So if the operator says he's going to produce 100 barrels today, I'll just cut it to 15 and I'll discount it at 18%. And if we get a positive NPV and we're happy with the due diligence, then we'll do the deal. That's the sort of basics of it here. We're looking to have a part of 5 wells by the end of the year, and realistically, with all 5 wells hitting at the right time, you could be making a couple $100,000 net to Red Rock per quarter. And we think that's meaningful. Again, it's not going to turn us into Exxon. This is not what this is about. This is about augmenting what's already there, meaning that we don't need to raise money if we don't want to, and that we can continue to monetize and develop the existing portfolio. Also, there is a plan to add a gas, actually. So really all I've told you about so far is oil. There is an opportunity actually to rework a well, which will allow us to connect a gas line and then produce gas off all the existing wells, including everything we're gonna drill from now on out. So it's an oil play today. It could be a gas play tomorrow. That's something that will develop over time. And finally, I'll just show you the economics. I mean, obviously these are subject to change. This is just our internal modeling, but it's as I said before. This is if we did 5 wells and then did nothing else. So this is sort of if you take it through Q4, do the 5 wells, and then everybody just shuts down. You just play it out over the next couple of years. Next year, it could net us something like 800,000 US to Red Rock. The year after that, 500, and that's normal as the wells decline. So as any oil investment, you would have to continue to build up to grow the portfolio. But let's just say we did the program I told you, then did nothing else for the next 2 years. This is what you would see. And we're excited about that. Again, we're not that large at the moment. This is a meaningful amount of money to our overheads and to, frankly, just running the business and exploiting the other assets as part of the portfolio that Andrew is going to cover right now. So I will turn it over to Andrew.
Yeah, so what we're doing there is we're getting cash flow, fairly reliable cash flow, which is low-cost production. We invested when it was $27. The price of oil in that area is now over $50, because this is very similar to Louisiana sweet oil. And similarly, with Jupiter Mines, we're looking to this coming to a revenue phase soon, where we start to get dividends from it. I mean, from the day that it began 2 or 3 years ago, it has been producing profits, but I had 3 months of loss making at the end of last year, beginning of this year, when the manganese price bottomed, and we in fact had a meeting in the middle of February where the price was $1.40 per dry metric ton unit. Everyone in the world was losing money. We know because we're the cheapest large-scale producer with 11% of the Chinese market, and we were losing money. But we cut our costs and we cut our costs and we cut our costs, rather as happened in the oil industry, and we reckoned that by the end of this year we'd just about break even at $1.40. But we said, but by the end of the year, we should be back to $2.80, which is not huge, but it's still pretty good living. Anyway, but by the time I got back on a plane, came back to London, settled in, looked at it a week later, we were at $2.80 already. So both in oil, where we invested at $27, now at $50 plus, and here, where we were looking at, in February at $1.40 per DMTU, and were then at $2.80 by the end of February, with some forward sales at $3.50. We had a couple of very good markers that enabled us as industry insiders to say, we think we have just passed the bottom of the market, the sentimental bottom and the price bottom. And so Jupiter Mines has just produced its results for the year ending February, and they weren't especially good because they included that 3 months losing money, because you just can't cut your costs as fast as the Chinese can cut the price they pay you. It takes a few months longer. We also, of course, had a revaluation for the audit purposes where we wrote off a little bit of the value, but we still reckon that the value of our stake in Jupiter on a continuing basis as a going concern is about equal to the market value of Red Rock. and in a good market could be worth somewhat more. It has some additional iron ore assets in Australia, but we're not reckoning on anything from them anytime soon. So that's a summary of what we have in Jupiter. It is an extremely well managed and extremely low cost producer and state of the art, and within the next months or year we'd expect either to take over other assets to bulk that up or to sell out the thing completely, because our partners there are mainly holding through a fund that reaches its natural end in a couple of years, and at that point the managers get paid according to the value crystallized in the fund and the return from the time we started. So our interests are well aligned, even though we have a minority 1.2% stake. This is a 100-ton truck, so relatively large. If you're standing beside it, you come to just above the axle. 4 Points Mining is our Colombian gold asset. We began originally with iron ore and manganese in Australia. Then we got into the other manganese in South Africa through Jupiter, where we were at one stage the biggest shareholder. We brought in partners, then we brought in projects with the partners, and those partners and those projects are what make it a great company today. Probably the world's best, or certainly the second best, manganese company in the world. GP, that is. Now we move on to 4 Points Mining, which is gold in Antioquia, Colombia. When the conquistadors went to South America, they were always looking for gold. They kept on finding silver. But the one place they did find gold was in Colombia, in Antioquia, and the area where we were there, and for 30, 40 miles to the north along the Rio Neche, every time since the 16th century that gold has had a boom, it's ended up by gold from this area being the predominant, most important area for production in Colombia. And yet, up to the modern era, it's only been mined at very shallow depths. And of course, there's been a lost generation in Colombia because of the guerrillas and the narco-traficantes. For a lot of people grew up from the time they qualified as geologists or engineers until very recently. You couldn't go to the countryside because it was too dangerous. So there's a lost generation who never really got to practice their professions. And so the last few years, investment has begun to go back in. It's still quite tough because there are not enough qualified people. And so in the end, we decided that it was too difficult for us as non-specialists to operate. And a year, or a little over a year ago, we sold to some specialists. And these were American, Canadian people who had run the mine before and made money from it a couple of decades ago. They've built up a gold mine in Nicaragua, where they were again doing deep, narrow vein mining, running a very good plant and mill, bringing in artisanal gold and gold from workings around, processing it and selling it, and building up a really profitable business. They've also now done the same thing in Honduras. So we sold to them for what was possibly not the best price at the time, but any buyer at that point was going to put some of the consideration in the future, and we knew that with most people, they'd never make those future payments. These were superlative operators, very good at what they were doing. They have got there, and that asset is now in a company called Para Resources, which is on the Venture Exchange in Toronto, and has gone up from a couple of $1 million capitalization with no trade to nearly $20 million now. And they're in production, they're producing gold, they're building it up slowly. From the beginning of May, we're accruing royalties there at the rate initially of 3%. We got a progress payment in January, we'll get another $225,000 in August, and there's $1 million note that we had, which was payable if they put this into a listed company. We consider that this constitutes such an event, and we have told them, as we've announced, that we want to get the $1 million stock and accelerate the note that otherwise would be repayable 2018. But the price that we think we should be paid at is half the current price. And this can actually be seen by looking at our announcements and Para's if you work it all out. But I'm not quite sure that they're going to be very happy with that. If we need to go to arbitration, we will. but we expect to be able to crystallize some value out of this. So it's been quite a successful investment, and we'll continue to get those royalties. In the third quarter, we should get our first royalty check. So with royalties from there, with income from Shoats Creek, making a profit on our office, and eventually we'll be getting dividends from Jupiter. We nearly paid one in 2015, but looking at the market as it was coming ahead, we thought we'd retain the money for the sake of prudence, and it's probably a good thing we did so. But at some point, Jupiter will be a dividend-paying company. Our interests are aligned with other shareholders. We all want dividends, and so we're going to have multiple sources of revenue, and some of these hidden assets in our portfolio will start to have real value. In the case of Jupiter, it could be substantial value. In the case of some of our other investments, there can also be substantial value. Looking at these things here, we have Migori in Kenya. Everyone's forgotten about that. It's 1.2 million ounces, again a historic asset of ours. When the gold price went up, the Kenyans, who were quite new to mining, some of them got greedy and people started to try to take the license from our local partners. We took the government to court. We are in discussions at the moment on a settlement, and we expect that to come about. If it does, we will have a substantially increased shareholding in that, and we'll be able to move on to increase the resource there. But at the moment, in the Red Rock price, I'd say that's valued at nothing. We have also invested with Metal Tiger in Goldstone Resources, which is a hidden jewel, which has really become rather depressed because it wasn't being run particularly actively. And it's got a nice tight shareholder base. It's very clean. It's got some great land holdings in Ghana, next door to one of the world's great gold mines, the Obuasi mine, that's produced 33 million ounces. And there's only been one drill season on this ground by this company, which was back in 2011, 2012. They got 602,000 ounces resource, and they haven't really had money since. But this is a perfect time at the beginning of a bull market to be going in there, activating it, working with them, making them resistant to an aggressive company, and this can be a leader in the field in one of the great mining companies of the world, mining countries of the world, with a base in some really good assets. And so our gold assets are going to come gradually to the fore again and be significant, because when the market starts to go up, then you can get multiples on your investment if you discover a gold resource or a mineral resource. Just as Mod Resources and Metal Tiger have seen multiples on their money by discovering copper in Botswana, and no doubt they will be finding that they go up even more multiples when they develop their Thai assets. So we have an opportunity to do things here through our own investments and through the investments we make in companies where we see an opportunity. We additionally have some other little stakes here that I'm not going to dwell on because none of them are particularly significant at the moment. But you never know what's going to be significant in future. So we have preserved our assets, preserved the value, preserved the things that have the potential to go back up again in the cycle. We have stabilized ourselves at the bottom, changed our cash flow position by reducing our headcount, reducing our costs, becoming a very low-cost operation, and getting one or two things that will produce cash flow. And so we're in the two most attractive commodities in the world at the moment, I think, which for cash flow and lack of complication, which are oil and gold. And they're both huge markets, and we're placed at the bottom of the market to make money from them. And you had some reflections at the beginning of this session from Paul on what happens when the market goes up and whether some people are good at playing that market or not. I remember a mining engineer from Ireland of my acquaintance who was involved in Ormond mining, who was absolutely amazed when they came from the Irish stock market to London. I helped them get a listing here and introduce them to investors. And he had this experience of going to London brokers. And here are these engineers who spent weeks, months and years slaving away in strange places, making mines work and so on. They come to London and they want to raise money, and you go to a broker and he says he'll raise you money. For the first 2 or 3 weeks, nothing happens, nothing happens. He's not particularly anxious to return your calls. He says, well, it's a bit slow. Then he goes to 1 or 2 meetings. Suddenly the money's there. And then they want this huge sum of money as fees for doing that. And he kept on bursting into laughter at the thought of it. He thought it can't be that easy to make money, you know. And so he developed this term for the financial world and brokers and people like that. He called them creatures of the forest. So he thought of himself and people like him as being hard-working engineers and things. And these strange people in the city and people running companies like ours as creatures of the forest. And well, the good news is that we're all coming out of the forest now because the sun is shining and better times ahead. Thank you very much.